Hey everyone, I am back with another video about dividend stock investing. In the last week, well actually the last 8 days, I just purchased 6 dividend stocks. And in fact, one of those 6 stocks I purchased 2 times. And so I have been incredibly busy. I wanted to start out the year on an aggressive note, reaching my financial goals. And so I've been making a lot of transactions in the stock market. I'm going to share all of those with you in the video today. Also, I want to take a step back and share in the video today the thoughts that are going through my mind right now, because as we close out January, we head into February, I have a lot that's going through my mind as it pertains to dividend stock investing. It's going to be a great video today. Before we get started, don't forget, please smash that like button. It means the world to me. And also, don't forget to subscribe because I have so many exciting videos on the way throughout this year. You don't want to miss any of them. And you may be thinking, Ian, why do you have this massive stack of Kleenex? Look at all that Kleenex I have right now. This is Kleenex from Kimberly-Clark, a stock that I own, and I have so many of them right now because I've been crying. The last few days, I have been crying. Don't worry, these are tears of joy. I have been crying because Kimberly-Clark just raised their dividend by 6.5%. And so many of my holdings have been coming in with fabulous numbers, fabulous earnings reports. Some examples are Johnson & Johnson, which just hit a new all-time high, my number one favorite position, my largest holding. Apple came in with some great earnings today, Procter & Gamble, and the list goes on. Get ready, everyone. I have a really exciting video in store for you today. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to get started right now with some high-level themes as to how I'm approaching the stock market as we conclude January, we head into February. This is what's going through my mind right now. And then later in the video, I'm going to go through all 6 stocks that I'm buying right now in great detail. So check it out on the screen right now. This is the first theme. And the first theme is literally just starting off the year strong, getting those buy orders done. You would be very, very surprised, but as I get older, each year that passes, time seems to move quicker. I think this gets accelerated because I have 2 kids, and so when you're married, you have kids, life goes really quickly. Things just start moving quickly, and you'd be surprised that there's just not that much free time available. And so what I have found when I have a goal, such as a financial goal, it is best for me just to place my buy orders, get it done, because I know the quicker I get it done, my stocks spin off cash flow that I reinvest. Some of it I'm using to pay my bills, but most of it at this time I reinvest and I start earning money while I sleep. And I need to earn money while I sleep because my precious time feels awfully limited these days because life is just moving so quickly, and that's the whole purpose of dividend stock investing. And so I'm just getting those buy orders done early in the year. The second theme for me right now, as you can see on the screen, at the end of January as we head into February, is staying true to myself. Let me explain this. There's a lot of hype out there in the media right now. There's a lot of chatter about all kinds of volatility, all kinds of crazy things happening, like GameStop stock, for example. In fact, if you want to learn what I think about GameStop, head on over to my Patreon. I'll link to that in the pinned comment below. I have 118 patrons. I'm so thankful for each and every one. And I just posted a blog post on Patreon last night, what I think about GameStop right now. But there's just a lot of hype, whether it pertains to GameStop, whether it pertains to IPOs or day trading or anything like that. And what I've seen is a lot of people, a lot of investors, a lot of dividend investors are getting caught up in the hype. But the fact of the matter is the reason I invest in dividend stocks is so that I can avoid the hype. The reason I invest in dividend stocks is so I can turn the hype off. I can turn the computer off. I can turn the phone off. I can go outside. I can go running. I can earn money while I sleep. And so for me, I have reminded myself in this season where it seems the stock market is facing an elevated amount of hype to stay true to myself, to stay true to my roots, to focus on my dividend stocks. And so that is a theme that is very near and dear to my heart right now. And I take a lot of pride staying true to my strategy, even when it's not the most popular strategy around, even when it's kind of boring, if you will, compared to a lot of the hype that exists around GameStop. Now, don't get me wrong, my best wishes and congratulations go out to anyone who has made a lot of money in GameStop. That kind of trading activity, however, is just not aligned with me, and that's why I need to be true to myself. Now, moving on, check it out on the screen right now. The third theme that's going through my mind right now is I'm paying homage to my core stocks. You may remember in one of my recent videos, I will link to it in the description below, I shared my entire framework for 2021 and how I am approaching dividend stock investing overall. And this year, I was actually not going to put too much money into my core stocks. I would say so far as time has passed, I have put more money into core stocks than I originally anticipated. And one of the reasons that I put more money into core stocks, I just bought more Coca-Cola, for example, is really to pay respect, to pay homage to my core stocks, to my core strategy. And this is something that I've done honestly, that has been influenced because of all the hype. Because of the hype cycle out there, I'm kind of a contrarian, and so I thought, hey, if there's all this hype out there, I just need to go double down on my core stocks, which have always served me well. It's my way of coping with the hype, of getting outside of the hype cycle, of just focusing on my thing, on my cash flow, my dividend stocks that pay my bills while I sleep. And so that's the third theme so far. Let's keep going. Check it out on the screen right now. What is the fourth thing that I'm thinking about? What am I doing right now in 2021? I'm focusing on my theme. I'm focusing on my long-term yield on cost stocks. And so I've been going really quickly with Utz, with Hormel, with Church and Dwight, for example. And so I have, that's been one of my goals this year. I wanted to add some stocks to my dividend stock portfolio that have lower yields in the short run, but have huge opportunity to grow those dividends over time. And those three stocks are three that are doing that. I'm going to discuss those later in the video today in a little more depth, but it's kind of this seize the opportunity type approach, just that those three stocks right now, I feel that they are at not bargain basement prices, but compelling enough valuations. And so I just want to go after my dreams. I want to realize my goals for the year, and I'm going after it quickly. And so what is the final theme that I'm thinking about right now? Check it out on the screen right now. What I'm realizing is that this market is reasonably efficient and that things can move really quickly. Sometimes when I see a stock that's on sale, I take it for granted. I think that it's going to be on sale for a long time. And a good example of this is Campbell's Soup. I thought Campbell's Soup and the other food stocks would be on sale for quite some time. It just so happens that just literally within the last week, they started surging in share price. Even Hormel Foods, which is one I just bought, it has been surging in share price. And so things can move quickly. Another example is Johnson & Johnson. I thought that stock would be bouncing around in the 140s, 150s for quite some time. Well, they had a good earnings report. Things are trending up. It just hit a new all-time high. It hit into the 170s. It's now back down into the high 160s. But things are changing quickly. I'm seeing that when a opportunity presents itself, when a moment in time presents itself with a good opportunity, I need to seize those opportunities because they don't last forever. And so as I am now a month pretty much into this year, I've actually built my Utz position to a point where I'm comfortable with it, where I want to add more, but honestly, I went really quickly on it. I went quickly on it the way that I went really quickly on AbbVie. Some of you may remember that. I'll link to my AbbVie analysis in the description below. Back in the day, when that thing was way down in the 60s and 70s, I was buying aggressively because I thought that that moment in time, that opportunity wouldn't last forever, and it didn't. It quickly disappeared. And so as I see some of these opportunities right now in 2021, especially with bargain stocks right now, Campbell's Soup is a good example. General Mills is an example, which I'm going to cover in the video today. Those moments in time, those brief opportunities, they can just disappear. And so that's why I'm seizing them very quickly. And so those are some of the themes that are going through my mind right now. As an investor, I'm always thinking at this level, just taking notes, trying to document my journey, trying to better understand and elevate myself, learn more as I go. And my themes are always emerging each month that passes through the year. And so with that, I want to move on to the next segment in the video. Please go ahead and share in the comments section below. I'd love to hear what are some of your themes as you head through 2021. What have you learned in January so far? What are you realizing with this wacky stock market that we're in? I'd love to hear in the comments section below. So moving on, I want to go through some of the stocks that I'm purchasing right now. So check it out on the screen right now. So I'm going to go through the 6 stocks in sequential order when I purchased them. So the first one, as you can see on the screen right now, is Hormel Foods. This is a stock that I purchased on the 19th of January, and I added more shares at $44.80. As I always do, I highlight the metrics on the screen that are most exciting to me. There's not too much highlighted here up top because honestly this stock is fully valued, if not richly valued. The forward PE ratio is in the 25 range for 2021 and 24 range for 2022, and the dividend yield is only 2.19%, so it's not that exciting. But what gets me exciting is the low payout ratio at 56%. There's a lot of room for this company to grow its dividend. The market cap is reasonably low at $27 billion. There's a lot of room for this company to grow by market cap. And perhaps what gets me most excited is the fact that the compound annual growth rate on the dividend over the last 5 years has been 11%. And so this stock is not going to make me rich right now. This stock is not going to drive a lot of cash flow that I can use to pay my bills right now. But if I hold it for a very long time and it keeps increasing its dividend every year like it has been for many years. It's actually, as you can see on the screen right now, they've been increasing their dividend for 55 consecutive years. If they keep doing that, if I look 20 years out, my dividend yield on cost is going to be huge, and I'm going to be able to use my cash flow from Hormel in the future to pay a lot of bills. And so that's what gets me excited about this, is it's a growth stock within my dividend stock portfolio. And so as you can see on the screen right now, in terms of recent news, there's not too much, although I do bold this because I thought it was exciting. At the end of January, they decided to open a new Papillion Foods expansion. This is going to be a facility that produces salami and dry sausage products under the Columbus and iconic Hormel brands. Now, I will tell you, as a consumer, I actually do enjoy the salami from Columbus, and I will say that that salami is of a good quality, at least in my humble opinion. I am not a snob when it comes to food, and so I can enjoy just pretty much anything, but I will tell you that that Columbus salami is good. And so it's exciting to see that in an environment right now that is kind of unpredictable, this company is out there in expanding capacity. And to me, that is a leading indicator that they are continuing to grow. And so with that, check it out on the screen right now. I want to go through just my thoughts. This stock, just a few days later, is already at $50.50. Literally, I just bought it at $44.80, as you can see, and now it's at $50.50. I need to move fast to accumulate my position. And so this is kind of the AbbVie strategy. There's a moment in time where there was some value, and I went quick to establish the position. I would say with Hormel, there's not really a ton of value here, but man, if it goes a lot higher, whatever value there is going to be gone. And so for me, as I approach this year, this ties into the strategic themes that I discussed earlier in the video. I am just trying to seize the opportunity a little bit earlier in the year. I want to build up a position in Hormel, and I would rather extend myself a little bit now within reason to do it it quickly than waiting too long and paying higher prices. Now, of course, there may be a market correction, a market crash around the corner. I never know. I certainly hope that that happens, because then I will buy Hormel and other stocks at lower prices. But for now, as I approach my investing, as I dollar cost average in, I have a strategic position I want to build. I've just got to go for it and build it to the best of my ability as quickly as possible, for the simple reason that it seems that other investors are like me and are seeing value in owning names like Hormel. So what else are my thoughts right now? What I'm also thinking right now is I love the dividend growth rate. I am not covering it in the video today, but they offer an incomparable balance sheet. One of the things that draws me to this company, to Hormel, in fact, I will show it on the screen right now. Check it out. This is their balance sheet. And one of the things that I like about Hormel is they have very little debt on the balance sheet. They have a strong balance sheet, one of the stronger balance sheets I've ever seen in this type of industry. And so I think that's really cool. What else do I love about Hormel? What am I thinking about right now? 55 consecutive years of dividend increases. So it doesn't get much better than that. So moving on, that was the 19th of January. Now, on the 20th of January, I kept up my buying streak. I kept going. And so, as you can see on the screen right now, I bought more Utz Brands, Inc. This is a smaller company in my portfolio, only a $2.9 billion market cap. Now, keep in mind, I bought it at $23.05 on the 20th. But then again today, on the 27th, I bought it at $24.03. And so I bought 2 tranches of this recently. I would say, honestly, I feel that Utz Brands, Inc. right now for me is at kind of almost a full-size position. They're at 0.5% representation, 0.5% allocation in my overall dividend stock portfolio. And so I'm building this one quickly, and I'm doing that with intention because I see something that I want and I'm going after it quickly. And so check it out on the screen right now. This company offers a PE ratio forward of 59 in 2020, 39 in 2021. Although those PEs are a little misleading because there's a lot of depreciation because they're growing through acquisition. And when I look up higher up on their income statement, and when I look at the EBITDA basis on an earnings before interest, taxes, depreciation, and amortization, honestly, their valuation is not so dissimilar from another of my favorite holdings, Campbell's Soup, which is another one that is skyrocketing in price. And so I'm very thankful that I've bought a lot of Campbell's Soup so far. And so these PEs are a little bit misleading. The dividend is very low, at lower than 1%. It's 0.87%. I use the 5 cents a quarter metric because my understanding is that dividend of 6 cents was kind of a one-time thing. And so I'm looking at it more as 5 cents a quarter dividend, but we shall see. I love the market cap at only $2.9 billion. They're number 3 player in the salty snack foods industry, but there's a lot of room to grow. I guess in terms of recent news, as you can see on the screen right now, one piece of recent news is that Citigroup raised their price target to $26. I don't know if that's really that exciting in terms of news, but it seems like the analysts are starting to catch on. And so you can see here there's a theme so far, and the theme is that I am seizing the opportunity. I'm moving quickly because I have defined stocks that I want to own. I want to build the positions, and I don't want to just buy like a small amount of Utz and then have the thing go through the roof and then I'm left in kind of a frustrating position, if you will. And so I have the means now to acquire my full-sized position in Utz, and I'd rather kind of front load that effort right now, knowing that, hey, if there's a market correction, look, it's going to tank and I probably move too quickly. But then again, if that happens, I'll just buy more. But for me, the risk of the market imploding upward is more than the risk of it imploding downward. With all the money being printed, all the activity I'm seeing points to people hedging their wealth, points to people putting their money in stocks as a hedge against currencies. And so with that overall backdrop right now, hey, a correction could always happen, and I would welcome that. But again, my bigger fear is that there is a market melt up, if you will. And if that happens, I want to build my positions that I have my eyes set on very quickly. And so let's move on. Check it out on the screen right now. I want to talk about the third stock that I just purchased, which was General Mills. This one, literally, I'm keeping up my winning streak. this one actually is, well, I guess I skipped a day, but this one's on the 22nd of January. I purchased General Mills at $55.18. Now, I put in parentheses next to this that it is already at $60.87. And so a lot of us in this community, I believe, thought, maybe I shouldn't speak for others, but I know I thought that General Mills, Campbell's Soup, those types of good deals, which are some of the best deals in the stock market, they would be around for a while. I thought they'd be around for months. Nope, they're disappearing pretty quickly. And so as you can see on the screen right now, what's so interesting to see is that I bought it at a PE of 14. I bought it at a 14.68 PE for 2021, 14.79 2022. Obviously, the fact that the PE goes up in 2022 shows that a lot of analysts think that the growth right now is going to be plateauing. But if you look a little bit further on the screen right now, at the current share price at $60.87, the PE is now 16. And at 16, I don't want to buy it quite as much. Maybe I'll buy another tranche, but honestly, I like it a lot better at 14 than at 16. And so it just goes to show, again, how quickly good value can disappear. Now let's keep moving. And so as you can see on the screen, one of the things that I love about General Mills that I do highlight is that dividend yield. Man, is that impressive. A 3.7% starting dividend yield, and the payout ratio is only 54%. And add on top of that the market cap is $37 billion. There's a lot of room there. I love it all. I guess one thing I don't love as much is the 5-year dividend growth rate, but it is low because of the Blue Buffalo acquisition, and now they are starting to increase the dividend again. In terms of recent news from their December earnings report, the fiscal Q2 adjusted EPS is up 9% year over year, and organic sales are up 7% year over year. And so right now, I would say a lot of people out there think that probably growth going forward is going to be slower for General Mills. But what I believe is, even if it is, this company is valued so nicely at that $55 range or lower that I just love it. I got to buy it at those levels. But now that it's rising up to 60, I don't know if I'm going to be buying any more, maybe another tranche, but I'm certainly reinvesting dividends. I love this company. And again, it goes to show that when I see something out there and I want it, I just got to go for it. Of course, within reason. I don't want to tap into emergency fund. I don't want to do something silly like go on margin, for example, or put myself in a bad financial situation. But I'm just saying, as long as I have capital that's available to invest, right now at least, rather than kind of segment it out for a few months, I'm just trying to front load it in January and February a bit, and then I'll probably take a bit of a break unless the market plummets. And in that case, I'll always be ways for me to kind of scrap together more money to put into my favorite dividend stocks. And so with that, I want to move on to the next one. Check it out on the screen right now. And so now I go from the 22nd and I jump forward to the 25th. And so on the 25th of January, I bought even more stock, and I purchased stock in the Coca-Cola company. And so this one may surprise some people because it's not at a very good valuation right now, and it's not really consistent with my 2021 goals. This one probably ties into the strategic theme that I want to pay homage to my core stocks, and I want to pay respect to them. I want to honor them in a climate where all the media is talking about GameStop. You know what I'm going to do? I'm going to go out and I'm going to buy Coca-Cola stock. And so as you can see on the screen right now, I bought more Coca-Cola at $48.60. I am not getting it at a great value. It's at a PE of 25 next year, or this year forward at a 23. And I do like the dividend yield at 3.37%. The reason that dividend yield is so high is because the payout ratio is high. That being said, I think this company is just fine with that kind of payout ratio. It's a very established company. I like the 5-year compound annual growth rate of 4.44%. It's a bit below my ideal target range of 7% or more, but 4.44 is respectable for a company of this size. I would say most excitingly, they made an announcement that they're going to offer this product called Coke with Coffee in the United States. I know they've been testing out this product in Japan, and now they're going to bring it to the US. I think this is particularly exciting that they're offering this product after acquiring Costa Coffee in the UK and in Europe. This is a coffee chain, much like Starbucks, which I do own in the UK. And so now I am long Starbucks and Costa Coffee because I own Costa through Coca-Cola Company. And so anyway, it's really exciting because the product that they're offering, I honestly, I probably can't taste test it just for health reasons. I don't drink soda anymore for my personal situation. I do drink coffee, and so I'm tempted to try this thing, but it's probably not going to be something I can try. But I can imagine what it would taste like, and in my imagination, it tastes very good, having a Coca-Cola experience with a little bit of a kind of coffee flavor in there. It sounds like that would just be a brilliant win for this company. And so when I saw that, I wanted to buy more shares. And so as you can see on the screen right now, I want to go through just a few more thoughts on this company. And one of the thoughts is just I made a commitment last year to add to my core ride or die stocks on somewhat of a consistent basis. And it's just been a while since I've added to Coca-Cola. And so I thought I would honor this commitment and just add more to Coca-Cola because it's been a long time. One of the things worth noting is I started buying Coca-Cola in 2011. And my first tranche, this is adjusted for splits, was at $31.19. And so it hasn't gone that far since when I first started buying it in 2011. And so the fact of the matter with Coca-Cola is it's not a get-rich-quick stock. The fact of the matter with Coca-Cola is I don't even know if it's going to keep up with the market. But what I do know about Coca-Cola with their iconic brand, with the products, the beverages that they make, is I can sleep well at night. It's a good core stock. It's a slower growth core stock, but it holds the core. It holds it strong, and they're going to keep paying the dividend. They're going to keep increasing the dividend. I can sleep well at night. I can use the cash flow to pay for bills, and I can rest assured, for me at least, that my money is in a really good space. Now, is it going, if my portfolio was only stocks like Coca-Cola, I don't know if that would be for me because it would lack the growth that I so desire in the portfolio as well. The dividend growth, that is. Capital appreciation, that's nice, but it doesn't much matter for me because I never plan to sell. But it is a slower grower, and that's just something to keep in mind with Coca-Cola. That being said, there are stocks, I don't own it, but Microsoft, for example, if you look back kind of in that range, I forget when, but it was in the earlier 2000s, I think, kind of 2003 through 2011, somewhere kind of in that range. There's many years where it went nowhere, and now you look at it, the stocks just flourished. And so one of the points I want to make with Coca-Cola is, yeah, the last decade has been slow for this company, but just because one decade is slow doesn't mean that the next one will be slow as well. Companies like Coca-Cola go through seasons, and that's why I can't really even evaluate something like this until I've been in it, say, for 30 years, because after 30 years, I'll have a real good sense of where the company has been. But in 10 years' time, one decade, hey, maybe it just had a slow decade. But even if the next 2 decades are like the last one, Coca-Cola serves a purpose in my portfolio. And that purpose is kind of holding the core strong in something that I can rely on. And that just is also a reflection of who I am as an investor and who I need to be true to. Because, yeah, I am a little bit more conservative than a lot of investors out there. And I am okay with that because that's how I live my best life. And I'm comfortable with that. And that's what works for me. May not work for everyone else out there, but that's okay. And each of us in the community needs to really identify who we are as investors and stay true to that. I think that's really important because otherwise, if you don't know what you are as an investor, who you are as an investor, it's easy to get pulled in different directions and potentially make mistakes. And so with that, let's keep going. This was a busy day on the 25th because in addition to buying Coca-Cola, I followed up with some Church & Dwight. And so Church & Dwight, I bought more at $87.75. This is not a bargain basement company by any means. It's trading at a PE of 31. Next, forward 21 at 28. 1% yield, low payout ratio at 34%, so a lot of room to grow that dividend. Love the market cap at only $21 billion, and I love that 5-year dividend compound annual growth rate. I think that is a really, really solid growth rate on the dividend. And so with Church and Dwight, I honestly don't have much to add there other than the fact that it's a new position. It's one that I opened in 2021. It's one that's a quick growing company. It's my way of getting exposure to growth. It may be a more conservative, a more dividend oriented way of getting exposure to growth, but that's how I do it. I'm doing it with stocks like Church and Dwight, and I just wanted to go in aggressively and buy more because I'm building a small position into something that is of respectable size within my portfolio, and I'd rather just keep on going after that target, going after that goal, because that's how I can check it off of my list. And so with that, I want to move on to the final stock number 6. This is the exciting one. This is the one that had me crying tears of joy. Let's talk about Kimberly-Clark. So check it out. And Kimberly-Clark, I bought more shares on the 26th of January. And what I did is I bought shares at $134.73. I was really excited by their earnings report. And I decided, hey, with that great earnings, which was a lot better than anyone expected, I'm going to go and buy some more. And so I bought it at a PE of 17 for forward 2021, 16 for forward 2022, a very respectable starting dividend yield of 3.38%. And a very respectable payout ratio of only 58%, so a lot of room to grow the dividend. Market cap is a little bigger at $46 billion, but still I'd call that on the smaller side within the scheme of things, within the scheme of my portfolio. And I like that 5-year dividend growth rate of 4.38%. It's kind of like Coca-Cola's, but better in many ways because their payout ratio is lower. So they have more room to grow going forward, just on a strict payout ratio standpoint. And what is so exciting in the recent news is they increased the dividend by 6.5%. They raised it from $1.07 a quarter to $1.14 a quarter. This is higher than the 5-year average. And so this is higher than Kimberly-Clark's 5-year average. This is rare. This is something unexpected for Kimberly-Clark. This was so exciting to see, and is one of the largest positions in my entire portfolio. This literally is just so awesome to see, and this is why I do it. This is why I'm a dividend investor. This is the type of hype I get excited about. This may not be the hype that fuels the overall market, the overall media, but it sure is exciting for me to see that. And so what else with Kimberly-Clark? Let's keep going. And so in their recent news, they authorized a $5 billion share repurchase program. In addition to that dividend increase, their Q4 sales were up 6% year over year. Their Q4 earnings were down by 1.2% on lower operating profits. So their operating expenses are a little higher. That's some of that inflation creeping in there. Generally speaking, I'm not going to fault them for one quarter where earnings are a little down when sales are that strong, because I generally am a believer with a company of this scale that the earnings will follow the sales. Put another way, if sales stagnate, there's only so much cost cutting that a company can do to grow the earnings. There's only so much of that. But as long as sales are growing, the earnings will generally follow. And so I was really excited to see that. And also what I was excited, as you can see on the screen right now, is their 2021 sales growth guidance was in the 4 to 6% range, which is higher than analyst expectations of 2.4%. And so this company is growing, and they're providing the products that we all need during this global pandemic. And also just as a globe around the world, people need tissue, they need toilet paper, they need the very products that this company makes to survive. And so in terms of my thoughts, I'm happy about the higher than expected dividend increase. I'm happy about the sales growth. I'm unhappy about the lack of EPS growth, but I'll wait. Nothing's perfect. And you know, if it stays in this range, I'll probably buy more. And this goes back to my point about paying homage, paying respect to my core stocks. Perhaps as I went into this year, I put a little too small percentage in my core stocks. Maybe as this year progresses, I'll fine-tune my plan a little bit, and I'm not going to abandon my plan of the growth stocks because I have a lot more money I need to invest in the Utz Brands of the world, in the Church and Dwights, of the Hormels. I wanted to buy more Apple, but honestly, that thing just keeps skyrocketing. I can't bring myself to buy it, although the earnings report was really exciting to see. But hey, I will probably be spending some portion of this year on core stocks as well, because I'm seeing some of that growth in these core stocks, even unexpected growth, which was so pleasant to see with Kimberly-Clark. And so with all of that, I hope you enjoyed the video today. Please smash that like button before you leave today. And please also subscribe. It means the world to me. I have so much great content on the way for all of you. Drop a comment below. What are you buying right now? What do you think about the market? Is the crash around the corner, or is a further melt up around the corner? We shall see. As always, I just keep dollar cost averaging. And so with all of that, I want to add a full disclosure. In terms of full disclosure, I am long the stocks mentioned today. I own Bitcoin, ticker symbol BTC. I own Utz Brands Inc., ticker symbol UTZ. I own Hormel, ticker symbol HRL. I own Church & Dwight, ticker symbol CHD. I also own Campbell's Soup, ticker symbol CPB. I own General Mills, ticker symbol GIS. I am long. I own Johnson & Johnson, ticker symbol JNJ. I am also long Procter & Gamble, ticker symbol PG. Another great earnings report. I am long AbbVie, ticker symbol ABBV. I'm long 3M, ticker symbol MMM. I don't know if I even talked about it, but I'm long 3M. Great earnings report. I am long Coca-Cola, ticker symbol KO. I am long Kimberly-Clark, ticker symbol KMB. I am long Starbucks, ticker symbol SBUX. On that one, by the way, stocks falling a little bit on that earnings report, which wasn't as well received by Wall Street as some of my other holdings. In the 90s, it's still kind of richly valued, but if that one falls into the 80s, 70s, I'm going to be buying some more Starbucks every Monday morning. And I am long Apple, ticker symbol AAPL. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. The stock market that we're in, it's kind of crazy. It's very possible to lose money in the stock market. And so please consult your licensed financial advisor before making any investments. Just sharing my story here for fun, my journey here for fun on YouTube. Before we leave, check me out on Patreon. Join the 118 patrons that are already over there. Unlock 18 bonus videos immediately when you sign up. I will link to that in the pinned comment below. All of the patrons help support my efforts on Patreon and here on YouTube, and it is so appreciated because it helps me produce even better content and invest in video equipment and items that I need to scale and improve this channel. I love you all. I will see you in the next dividend investing video.